welcome everybody to the 41st Annual Eide Bailly Bank Seminar. Today will mark the end of our series for the bank seminars for this year. And we look forward to bringing you more thought leadership in 2022, and hopefully it will all be in person. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you for all your service you provide to our firm and to our clients. Thank you all for attending this virtual event today. My name is Gary Smith, and I'm the partner in charge of the Financial Institution Service Group at Eide Bailly, and I'm excited to host you today. Our motto for this year is community, and we recognize how community banks have brought unity back to their communities, as evidenced by your unwavering commitment to the success of the businesses and individuals in those communities that you serve. Your contribution to a bright financial future in your local and regional economy is recognized, and it's respected. We are honored to have you all join us today. We've gone all virtual this year rather than the in-person events. Our first hour, you will hear from Doug Duncan, Senior Vice President and Chief Economist at Fannie Mae, and we have our ever-popular tax update in our second hour. We appreciate your attendance, and keep an eye on the website to find the recordings for many of our sessions that we're able to publish with the permission of our outstanding speakers by visiting us at idebailly.com/bank seminar 2021 and learn more about how you can help succeed. You can go back to idebailly.com/FI. Before we get to our keynote, I would like to extend a special thank you to Cheryl Knutson and Amy DeGeorge. I just want everybody to know we started planning these events over a year ago, and that was to have 5 in-person events. And it was all planning, a lot of hours, a lot of work, and Amy and Cheryl were instrumental in all of that. And about 3 months ago, we made the decision to go back to virtual, and there was a lot of work that had to be done. All the training sessions and all of the meetings before the meetings and everything else. Amy and Cheryl, I can't thank you enough. And on behalf of all the partners in our group and in the firm, thank you for all that you've done. I'm honored to introduce our keynote speaker today to kick us off, Doug Duncan. Doug is a Senior Vice President and Chief Economist at Fannie Mae, where he's responsible for forecasts and analysis of the economy and the housing and mortgage markets. Doug received his PhD in agricultural economics from Texas A&M University and his BS and MS in agricultural economics from North Dakota State University. Doug, I understand the NDSU Harvest Bowl is this weekend, where the NDSU Bison are playing against the University of South Dakota Coyotes at the Fargo Dome. Cheryl wanted me to remind you that they'll all be there rooting for you this weekend for your beloved Bison. I guess it's pronounced Bison and not Bison. Doug, over to you.
Thanks very much, Gary. I'll definitely be tuning in to the Bison to see how that goes, in hopes of making it down to Texas for the last game of the season, which I've done a couple times. It's been great to see lots of friends from North Dakota down there. So thanks very much for the invite, and it's good to be back with folks from the home country. But of course, a lot of you swing down to see me down in Cape Coral, Florida, starting about this time of the year. So if you come down, swing by and say hi. I'm going to talk about 3 things. Of course, the company always wants to make sure that you know that my opinions are only my opinions. And I try to give them a reason to require that disclaimer. So the 3 questions that are about 90% of the questions that I get from folks are, what about inflation? What's it mean for interest rates? And what about house prices? So I thought what I would do is I would start with a discussion of the things that we think about with regard to the Fed, because they're front and center for a couple of reasons. One is the level of inflation. The second one is because the term of Chairman Powell expires in January, and so there's a question about what's going to be the relationship between inflation and his potential reappointment or change by the administration. And then I'll go to the things in the macroeconomy that they're considering, a little bit about interest rates, and finish up with some conversation about housing. And I want to end with plenty of time for questions, because that's the part where I learn, where you ask me things I might or might not have thought about. So the things I talk to people about, there's about 10 things. First of all, what is transitory? And now the Fed has kind of moved away from using that term, but I looked it up in the Oxford English Dictionary. I assume all of you have that sitting on your desk, as do I. And the first definition of Oxford English Dictionary is not permanent. That's a lesson in how economists give themselves wiggle room. But one of the regional chairman, Raphael Bostic at the Atlanta Fed, recently said that's a dirty word at this point. So the Fed has really stopped using that term recently, because in people's mind it tends to mean be synonymous for something temporary, and the inflationary rise is looking less and less temporary. So the second thing is, will the Fed announce tapering? The answer to that we know. The answer is yes. They announced it at their last meeting. But there were some things in that announcement that are worth thinking about. First of all, they announced 2 months dollar volumes of reduction in their purchases. In the first month, they'll reduce the purchase of treasuries by 10 billion, another 10 billion in the second month. The first month, they'll reduce mortgage-backed purchases by 5 billion, in the second month by 5 billion, and after that, it's indeterminate. So what they've done is they've given a little bit of information to the market, but they've left open some potential for volatility. If they were to continue on that path, by the end of June, they would have ended their taper, or their reduction in purchases. But in that period, they would have also added 400 billion to the quantitative easing. So there is a question about that pace, and I think part of that question will be answered with next month's CPI, which is released prior to their next board meeting. If it's in the 6 range or above, and we have some work within our own forecasting that suggests it could easily be 7 or 8% annualized, the chances are reasonable that they would accelerate the decline in their purchases. So that's certainly something to watch and see what the market reaction is. To this point, they have telegraphed the taper long enough that we didn't get a taper tantrum like we did in May of 2013, when Chairman Bernanke announced, without having conditioned the market, that at some point the Fed was going to stop purchasing securities to add to their portfolio. And in the next 6-month period, there was a 100 basis point increase in mortgage rates, which led to about a 7% decline in sales during the next peak buying season. So the fact that Powell was on the board for that, and also for the 2018 experience, which I'll come back to in a minute, suggests they're wanting to get information to the market earlier rather than later to prevent that kind of a rate change. And we have not seen that dramatic of a rate change to this point, even though they have announced the taper. What's the end date of the taper? Well, I referenced that. They said mid-year. That doesn't necessarily mean June 30th. It depends on how wide their view of mid-year is. It could be all the way from May to July. So if they accelerate, they could end it even sooner than that. Or if they see weakness in the economy, they can extend that time. Fourth thing is, in the press conference, not the most recent one, but the previous one, there was a reporter that asked the chair, would you start raising the Fed funds target before you have ended your tapering? And his answer was, well, those two things work at cross purposes. So yes, we would end the taper before we raise the Fed funds target. Well, that's another clue about why they might have left open the pace of tapering after the first 2 months, Because if they do get one or two strong inflation measures, again, they may well accelerate that, so they could also accelerate the increase in the Fed funds target. And of course, for those of you who, with all of the economists, macroeconomists in the world, are breathlessly at the Fed website when they make their release and show the dot plots, over the last 6 months, the number of members of the Open Market Committee that think they would raise rates in 2022 has gone from 0 to about half of them. So there's no question they have adjusted their view on inflation, hence in part the reason why you're not hearing the transitory very much. Other central banks there are a couple of them that already are doing both the continuation of their taper and raising rates. So it's not as though it isn't happening somewhere around the globe, but that's their current position, is they would separate those two things. A sixth thing is what should we think about their balance sheet? I've said I would come back to the 2018 experience. In 2018, they were raising the Fed funds target, but they were also shrinking the balance sheet. At present, Chair Powell answered the question about what they were going to do with the balance sheet by saying, we haven't even talked about that, which suggests they don't intend to change the total holdings once they end the taper in terms of the level, at least not for now. But one thing that they could do is for maturing mortgage-backed securities, they could, for example, choose to reinvest those funds in treasuries, thus holding their balance sheet constant, but changing the composition if they felt like their monetary policy was adding to house price appreciation and they wanted to use one tool to slow that pace of appreciation. So seventh thing is, I think one of the things they're going to have to do, actually two things they're going to have to do at some point, is they're going to have to give the markets a sense of what they think the long run growth potential of the US economy is. At the present time, they have punted that commentary on that to the Congressional Budget Office, which gives their perspective on how fast the economy can grow without inflation, and it's somewhere around the 2% range. So the Fed might have to give a view of what they think is possible, and then tie to that, what is the long-run interest rate that is neither stimulative nor contractionary? Economists call that R star. So if you want to throw a little economist jargon into your next cocktail party, although I wouldn't recommend it, but you could talk a little bit about R star. That just is what's the neutral rate of interest, not stimulative nor contractionary. And they really haven't commented on that either. So a ninth item is the composition of the Federal Reserve. So the chairman's position comes up in January, but there are a total, with resignations and existing open seats, there's a total of 5 additional appointments that the administration could make, and that could be a pretty substantial shift in the posture of monetary policy, depending upon what those appointments are. So that's something to watch. And then for us in the forecast space, and then I'll go back, I'll turn then to some of the forecast components. The question is, does the market already have all of this priced into it? I would say there that markets are efficient, but they're not perfect. And so people sometimes confuse those two terms. And an example of efficiency but not perfection, if you go back to the beginning of 2021, there was a run up in the 10-year Treasury. In fact, it overshot the fundamentals. It got up to about 1.8, I think 1.74 or something like that. And then it came back down closer to 1. as it sorted through the fundamentals. So it was efficient. It got to the right place, but it wasn't perfect. It didn't go there immediately and stay there. So that is something to consider as the Fed changes policy posture. So let me turn then to some of the things that the Fed is looking at. GDP today is basically back to where it was prior to the trend. And so typically in the past, when GDP growth has exceeded what is viewed as the potential growth, it almost always results in inflation. So that's really where we are today, is we've actually slightly exceeded what the CBO projects as potential GDP, and we're seeing some inflation. So those two at least are correlated, if not causal. You've heard about the supply issues, and that was basically the argument which the Fed deployed to say that the inflation is transitory, in particular in the auto space, which I'll show you in just a minute, suggesting that there had been disruption because of the COVID. There had been disruption to supply chains around the world, and those would soon be sorted out and things would return to normal. This is the small business sector's perspective on whether their inventories are right or too low, and it's pretty striking the percentage of small businesses that suggest they're well below where they would like to be in terms of inventories, which relates obviously to the development of supply. I think there's that place that there was confusion in market in the discussion of supply was the difference between supply blockages or supply chain restructuring. And our view is that an example of the blockages is the ships that are anchored off of Long Beach, but and those things may well get repaired in a reasonable time. But there is also underway a geopolitical reckoning with what's ultimately going to be the role of China. And some firms around the globe are restructuring their supply chains to lessen their dependence on China for a multiple of geopolitical reasons. That is time consuming and expensive. And it's one reason why we've had inflation running above the Fed's forecast of inflation for some time, and do continue to have it above the Fed's forecast of inflation through 2023. Obviously, policy changes that they make in the interim could alter what the path looks like in 2023, but if current conditions maintain, we believe that the run rate of inflation will be above what the Fed is projecting, and it's in part because of that difference in the definition of supply chain problems. One of the things that is interesting, and we were talking a little bit about this before we came on, is if you project the level of cash held in checking accounts at households over the long run, it's a pretty stable measure. And right now, households have about $2 trillion more on their in their checking accounts than you would have expected given long-run patterns. Question is, what are they doing with that? So if you compare it to consumer sentiment, which certainly has not fully recovered to the pre-pandemic level, and you can kind of see in the measures the impact of, first of all, the virus, but also of the variant, the Delta variant of the virus in consumer attitudes. So some of it is simply reticence to go out and spend. Some of it may be precautionary based on whether or not they think there would be another recession in the offing. And part of it may well be that, particularly in the upper income categories, they're holding reserves against what they expect might be increased taxes. And I know you're going to have some discussion of taxation later on, so I will leave that to that discussion. The employment is something the Fed has commented on regularly, that is part of their dual mandate, and that they have not seen the full recovery to pre-pandemic levels, and that is true in the number of people who were working then versus the number of people who are working now. But there are some estimates of up to 2 million people who permanently left the labor force into retirement during the COVID. And with the unemployment rate is currently at the level which 15 years ago, macroeconomists would have told you is full employment. And so there's an interesting subtext there about the number of unemployed and the number of job openings, which there are currently more job openings than there are people who are looking for work. So this chart simply shows what happens in a recession with a starting point of the maximum employment at the beginning of the recession, how far unemployment goes, and how long it takes to get back to that pre-recession level of employment. What you can see here is, if you look carefully through these lines, is that each of the last 4 recessions have taken longer and longer to get back to the pre-recessionary level of employment. It's not really well understood why that's the case, but something structural seems to have happened. And you can see the recovery in from COVID, which is the pink line. It's back fairly significantly, but has sort of flattened out. And the question is whether or not we'll get back to that level anytime soon. Households, there's been some survey work on what people are doing with the time that they save from not commuting. And actually, what you see is that they're actually working more hours. It's something we've watched at Fannie Mae. And there's a parallel set of comments that come from our staff as we survey internally about working harder. And while there's no question in the minds of management that people are working hard, the question of working harder is difficult to measure from an output perspective. But one of the things that we think is happening is actually more in the realm of psychology, which is, if in the past when you commuted, you had responsibilities at home, when you left on your commute, you made a mental shift to the responsibilities at work, and then you reverse that when you return to home on your commute at the end of the day. Today, if you're working in the home, in some cases it's very difficult, and we've had to work through, as I'm sure many of you, what working remotely means, depending on the kind of family structure that you have, and the kind of adjustments that you had to make to be able to effectively work at home and meet the family responsibilities as well. So interestingly, there's some evidence presented here that some folks actually did put in more hours then, which supports the working harder perspective. But we think that other factor is important too, and will probably be an input into how we think about when or if we return back to work in the office. It's still the service sector, the leisure and hospitality, where the biggest share of jobs lost have not been recovered. That's not surprising. The auto industry and the chip problems of the auto industry are well documented. And still some time to go to recover in that. Looking at people eating out at seated diners, you can see the impact of holidays in here, and also of the Delta variant. And in terms of TSA traveling, that is on the airlines, myself having flown to the West Coast and back 4.5 hours, seated shoulder to shoulder with somebody wearing a mask on your face the entire time, not a premium travel experience, I would say. So it's not surprising to me that we have not seen a full recovery. And I'm guessing that at least at the margin, part of the reason gas prices are where they are is you don't have to drive with a mask. I suppose that depends on a variety of household factors, but I would expect more people are driving that might have flown at one point. So what do we think for the economy? We think this year we're going to finish at somewhere between 4.5% and 5% growth, but that's a decelerating growth path. And next year, I would say, depending on what happens with the Fed and the CPI, that 3.7 growth rate is probably on the high end. And I would say the risks are more to a slower rate of real growth. And as you can see, we see it's decelerating into 2023 to what we think is the long-term, something close to long-term potential growth for the U.S. Economy, somewhere around 2%, given its current structure. That suggests that unemployment will get down to that 3.7 level by that time frame, which again, 15 years ago, that would have been considered a point at which the economy would overheat. But the fact that there are more jobs offered than there are people looking for jobs suggests why you might get there and why that CPI might be where it is, given wage pressure emergence over that time frame. So as you can see, we anticipate with that slowing and with an expected tightening by the Fed, we don't see a precipitous rise in the 10-year Treasury over that time period. And the risk is actually that if the Fed acts very aggressively, that those rates could, while in the very short run, potentially rise, certainly could tip over into recession out in that 2023 time period. So there's the dot plot that I referred to earlier, and there's also the and as you can see, the participants in the Open Market Committee are anticipating potentially a couple of increases in 2022. Our forecast incorporates an increase in the fourth quarter and then increases each of the next 4 quarters. And we've taken those to be 25 basis point increases, but it really depends on what happens with the next couple of CPI releases, whether or not they would be more aggressive than that. I think that's something you have to watch carefully from a risk management perspective. The Fed holds 30% of mortgage-backed securities that are in existence, and they are not a financial buyer or an economic buyer, I should say. They are, in fact, a policy buyer. So the decisions that they make on agency and other security purchases in many ways are distortive of real prices in the marketplace, and that's intentional from a policy perspective. But as they exit that perspective, you should expect some volatility, even though they're going to try to lead the market with forward guidance. So I would expect there'll be some increased volatility. As I said, the CPI is running ahead of what they expected. We were above consensus consistently on the inflation front, but we weren't even far enough above, as I said, with that 6+% CPI. We had something more in the neighborhood of 5 in mind. We did issue a piece about 4 months ago ahead of the CPI coming out, saying that we thought that the Fed had underappreciated the contribution that housing was going to make, because housing makes its contribution on a lag basis to the rental space, where leases are renewed roughly on an annual basis. So while we in terms of different measures from a time perspective, we can see that the near-term inflation expectations have ramped up dramatically. Intermediate term, not quite as much, and the 5 years have risen, but not nearly as strongly as the more near-term measures. If you look at housing, you can see where housing has now in 2021 started to ramp up its contribution. And our view is it will add a full point to inflation measures over the next couple of years, each year for the next couple of years. That's been one of the reasons we've had a measure of inflation that has been higher than what the Fed has suggested. So in terms of our full rate path, you can see here we expect the average 30-year fixed rate in 2021 to be around 3.1. That's pretty much, that year is pretty much done. That's pretty much close to where it was, maybe even a little bit lower, 3%. We expect by the end of 2022 that we'll see rates around 3.4. We are below the consensus on that. One of the things you should know about our forecast is we impose the forward yield curve from the last business day of the previous month on our successive month's forecast. Our view is in the long run, the bond market is better than any individual economist at figuring out where rates are going to go. And that typically has been a pretty good strategy for looking at interest rates. The adjustments we do make are through the Fed funds target and to reflect the impact of monetary policy on that. And so that slowing that I showed you in GDP in 2023 relative to 2022 shows up in the lower rate of the 30-year fixed rate mortgage than you might have anticipated after 3 years of growth. It also suggests that the Fed is successful in creating a soft landing from inflation. That's obviously a big risk in this forecast, and why I've suggested you need to track the CPI for the next couple of months, because the Fed is likely to react if those numbers are very strong. So we give just maybe about between 5 and 10 minutes on housing, and then move to questions. So everybody's aware that house prices have risen strongly. They rose about 15% national average in 2020. They're rising about 20%. I think right now the measure is about 18.5% in the data that's in so far in 2021. These are historically high numbers. And our view is that the pace of increase will slow in 2022 to somewhere between 7 and 8%. Importantly, in the middle of this is the distribution between the different income levels or house price levels within markets. So if you take an individual market and divide it into high third from a price perspective, middle third, and low third, in every instance since the recovery from the 2007 to 9 downturn, it's the low price segment that has been appreciating the fastest. And part of that is in 2015, that was when the millennials entered on the demand side. And since then, the demand side in housing has been being driven by the millennials. Because the boomers were doing what they said they were going to do, which was age in place, the demand pressure has been stronger than what the builders could keep up with, because the burden fell on builders because the existing home supplies were just incredibly low. So this is my current favorite chart, and I'm an economist, so I get to have a favorite chart. And I threatened my staff to have it put on T-shirts and make them wear it. I haven't followed through on that. But those are the kind of things that we do at economist parties, which is why you don't go to them. But what we're trying to demonstrate here is, how does the supply side of housing respond to price signals? So we have the dark line is the year-over-year percent in inflation-adjusted house prices, and we take a little bit of the volatility out by using quarterly averages rather than monthly numbers. And the orange line is single-family starts per 1,000 households, so we can take change in population out of the equation and look at housing proportionate to the population. What you see is that lead in price is very strongly correlated with supply response all the way out into about 2010. Now, since that time, first there's that jump in 2010, and if I was in the room with you, this would be on the quiz. What caused that jump? And to both go up and down. And the answer to that quiz is a first-time homebuyer tax credit. So we put into place first-time homebuyer tax credit of a temporary nature. So it had a fixed term. And they actually extended a little bit when the first term ran out. They extended a little bit, but then permanently got rid of it. So the lesson here for policymakers is, if you are stimulating demand in a market where supply is inelastic, meaning it doesn't move very fast, what you get is a price response. And we got absolutely a price response, but builders take several months, like 9 months or so, to build a house. So supply couldn't respond nearly as fast as households, which is basically instantaneous for households. And so you get that, you get a jump in price. And of course, when the program expired, price resets to its natural level. And most of those people who bought on the upside were going underwater on the downside, depending on how much of a down payment they made. Then, obviously, when the housing market on the demand side started a more broad-based recovery, that is, household income started to rise, employment picked up, less people were underwater, all of those factors, you saw a rapid appreciation in house price from declines up to positive growth. And so there were these strong price signals and a very gradual growth in supply. Well, why was that the case? We have to go back to the 2006 to 2009 time period and look at that orange line. We went from making about 1.6 million single-family housing starts to about 300,000. So we essentially destroyed 3/4 or 4/5 of the supply chain in housing, and it stayed destroyed for roughly 3 years. So all the people that were construction workers, or were making PVC pipe, or who were making bathroom fixtures, the demand for those had fallen by something like 80%, 70 to 80%. So they were laid off. I bought a house in 2010 in Cape Coral, Florida. I went to the permitting office of the city to get a permit to do some remodeling. There were 2 people in the permitting office. They were self-funding. There hadn't been any requests for permits, so they laid off all of their staff. So all of that had to be built back based on gradual growth in permits so they could hire another person. The same story all along the food chain, which is still attempting to recover from that downturn. So the starts numbers, which have come out, and construction numbers, permits and starts, I should say, which came out, are essentially flat in the fourth quarter. Right at the moment, as you'll see in a moment, the builders have sold more homes than they haven't even started than has ever been the case before. And so new home sales will likely actually fall a bit in 2022 because builders have to actually build the houses they've committed to build, and supply chain problems are rampant. I'm working on building a house myself. The builder tells me it will be 5 months before I can get trusses. And you can see that in the COVID period, the decline in interest rates dramatically stimulated demand, and with slow growth in supply, prices went astronomically high. That's really the story of what's going on. So until that supply curve catches up to the demographics of demand, we expect to see strong house price appreciation. This just suggests, not surprisingly, that housing starts need to have some relationship to population growth. As we note here, in an MSA with a 3-year net population growth of 90,000, they'd have to issue 12,000 permits a year to keep up with that population growth. So you can see geographically where the opportunities are that builders are taking. So let me, in the interest of time, jump forward. I want to talk for a second about fiscal stimulus. This chart suggests that a family of 3 who was under all the caps for all the different iterations of stimulus would have received $11,400 of stimulus money. Interesting sidelight here. One of the things that was learned in the policy world is that if you want an immediate demand stimulus, we now know we can use the US Treasury rolls to directly inject into household savings accounts stimulus money. That is something to kind of tuck away in your head as you're thinking about how politicians will respond to the view of whether or not and at what levels and how stimulus should be provided. But if you take that $11,400 and convert it to a 3% down payment, assuming you have decent credit, that's a $380,000 house, which tells you why the lower and middle thirds of house prices in any market are the most strongly appreciated. Not that all that money went to buy homes, but at the margin, enough of it went there to have an impact on the demand side of the equation. I've talked about these things, so I'll make a quick stop at credit conditions as people are worried about declines, whether or not there could be the kind of a decline that we saw in 2007 to 2009. So I've given you a look here at first-time home buyers versus repeat buyers, and what you can see is the average debt to income is still down in the area where it was in around 2017 or thereabouts for both first-time and existing or repeat buyers. The average LTV has actually fallen for both first-time and repeat buyers over the last 4 years or so. And the average first-time buyer and repeat buyer down payments have risen. That would be related to that decline in the LTV. And the average FICO has held up very well for both first-time and repeat buyers. So from a credit quality perspective, things look pretty good. That doesn't mean that nothing could go wrong. Unemployment always causes a problem. If we were, according to my comments at the outset, to see the Fed tighten very aggressively and put us into recession, then there would be a test of these underwriting criteria. But it seems as though households are in somewhat better position to survive that test, and they're definitely in much better position than they were in 2007, 2009. One thing that suggests to us that the market will slow is in our monthly survey, we ask, is it a good time to buy? Is it a good time to sell? The most recent significant departure to peak levels has been for those who say it's a bad time to buy, the number one reason is house prices are high. For those who say it's a good time to sell, the number reason is Number one reason is house prices are high. So those two things simply signal that with interest rate increases, if combined with interest rate increases, you should expect slowing in the housing market as affordability constrains. Evidence of that lack of supply, the percent of homes sold above list price went over 50%. It's now slightly under 50%, but a more normal would be 25%. So very short supply. Homes off the market in 2 weeks at historically high levels. Single family housing inventory at historically low levels. Average days on the market at historically low levels. Again, the supply side of the equation is really where the concern is. So let me jump and end my comments with the forecast, then you can come back and ask me for anything that you think you would like me to fill in on. As you can see, our expectation is for mortgage rates to average 3.3, ending the year at 3.4 in 2022, heavily dependent on what the Fed does. Even that modest rise in rates, given how many people refinanced in the 2020 and 2021 time periods, would see about a 50% reduction in refinances, but actually an increase in purchase production that's measured on a dollar basis. As you can see, the total existing home sales we expect actually to fall a bit, so the number of homes financed will fall, but price appreciation will hold the dollar volume up. So still a pretty good year in 2022 and 2023, but heavily dependent upon what happens from a monetary and fiscal policy perspective. So let me end my comments there. I'm going to hand it back to Amy, and then I'll take questions, I think, moderated by Gary. So I'll see how well Gary likes me.
All right, Doug. Yeah, good question. I think that came in was, you talked a lot about consumers holding onto their savings more so than in the past. And you talked about one of those reasons, potentially they're preparing for a recession. I guess, when do you think, what are some of the levers out there that you think we might see our next recession?
Well, our thought is if there is a recession, it would be more what you would call a normal cyclical recession because it's related to inventory. The supply issue is really the challenge across the economy. And if the Fed gets aggressive on raising interest rates to slow demand, then it may well be the case that the ramp up in inventory building will overshoot what households will be ready to absorb, and you'd end up with more of a classic inventory cycle kind of recession. We've gotten a little spoiled, well, not a little, we've gotten quite spoiled over the last 25 to 30 years in that the frequency of recessions reduced dramatically. We had two periods where we went the better part of a decade during the starting of the Reagan administration, and then again during the Clinton administration, when we went very long time periods without a recession. That's not normal. If you go back to the post-World War II period, until that, from say the late 1940s out until the early 1980s, the recessions occurred every 3 to 4 years. And they were typically that type of recession. It was an inventory overshoot, a tightening by the Fed, turn down in demand, and housing typically led that rise in interest rates, turned housing down, which led the economy into recession. And then when rates fell and housing picked up, it helped lead us out of recession. The 2007 to 9 was highly unusual recovery because housing was the cause, and mortgage credit related to housing was the cause, and other factors led the economy out of that recession. So it was atypical. This recession is also atypical in that it was a health event. It wasn't actually an economic event. It was a health event that had economic consequences. So it too was unusual. So our thought is that the next recession will be more of a typical post-World War II inventory-related recession, particularly because of that issue of restructuring supply chains as opposed to just blockages in supply chains.
So Doug, when you think about stress testing and, where do the risks really lie when you're thinking about the economy? Where does it lie?
Well, I had to spend some time with Fannie's board of directors yesterday talking about the impact of tapering. And I broadened that a bit to look at Fed policy. And I would say right now, the biggest question is Fed policy. And if they are actually behind the curve sustainably in order to lock down long-term inflation expectations, they will get aggressive. And if they get aggressive, that means tightening. That typically means slowing economic activity, and could easily, with growth slowing towards the 2% path, that's pretty close to a kind of a tipping point. And they could easily tip that over into recession. One of the things that we have in our forecast now, because the legislation was passed, is the stimulus bill. The infrastructure bill. Some people think of that as a stimulus action. It's not. Properly done, infrastructure is intended to improve economic efficiency. So if you think, most people use the Eisenhower administration and the interstate highway system as the premier example of infrastructure. Well, what they forget is the year after that was passed, there was a recession. So infrastructure bills are not immediately stimulative. Think of the fact that most of the contracting that's done in those things is done at the local levels, and the local infrastructure for those things takes time to adjust to the demands for the execution on those funds and bridges and highways and airports and all that. So we put that into the forecast, but it's only marginally impactful in the short run. In the long run, it will improve productivity in the economy, but that's a more long run factor. We do not have any additional stimulus or programmatic spending in the budget yet, because we just don't know what the outlines will be if it is passed. And I know the administration and the Congress would like to pass something before Christmas, but there's a lot of wrangling over the details, and so we've not put anything into the forecast yet. So right now, from our perspective, the biggest risk is in the monetary policy arena.
Well, we'll have to just kind of keep up with the Fed, right, Doug? I think at this point, and see what happens, right?
Yeah, that's right. In terms of key indicators, what I would watch are what happens with CPI. People watch CPI. Actually, the Fed monitors headline PCE, which also is released monthly. They feel that measures the changes in composition of what people spend better. But that's running well ahead of what they expected as well. So if it continues to run well ahead, I would watch that. And then I'll take you back to this Danny Blanchflower, and he watches consumer attitudes. And we've seen in our survey that the homeowners, we can divide between renters and homeowners. And for the last several months, homeowners have been getting increasingly pessimistic about the outlook. So those are a couple of things I keep an eye on.
Plenty of things to keep you up at night, right, Doug? For
Absolutely.
Sure, right? Well, Doug, we're at our time as always. On behalf of our firm and all of our clients, we want to thank you for spending the time with us today. And again, we hope the Bison have a good turnout this weekend.
Absolutely. Thanks for inviting me. Good to be
Thanks,
with
Doug.
You. You bet.
All right, we will turn it now over to Paul Sirek. Paul is our director, our partner in charge of our financial institutions tax practice. So Paul, over to you.
Thanks, Gary. It's time for our annual bank seminar tax update. There's a lot going on, a lot in flux this year. Is kind of like where we were 4 years ago, if you remember. So we'll try to bring you up to speed as much as we can here today. As Gary mentioned, I am Paul Sirek. I serve as the firm's tax director of our financial institution services group. I've been working with community banks and serving as in a tax advisory and in an M&A advisory role for community banks since 1995. Jay Heflin is also with us, and Jay's going to lead off the presentation. Jay is in our Washington, D.C. Legislative Affairs office as part of our firm's national tax office. Jay is the assistant legislative director, and again is in DC amongst the activity right now. So Jay will be bringing us up to speed. Jay has 21 years of experience as a reporter covering topics related to tax planning and compliance, legislation, accounting, political developments, business policy, and more. He also has 9 years of experience working in the tax and accounting field. So Jay holds a Bachelor of Science in Accounting from Butler University. Jay, I'm going to hand it over to you in Washington and bring us up to speed.
All right, thanks, Paul. So before I start anything, things are changing dramatically here in Washington when it comes to the reconciliation bill. So I might get something on my phone that will change these slides dramatically, just to let you know. But let's start where it all began. This is the basics, and you probably already know this, but it's just nice for the people who don't know it. The Democrats hold a slight majority in both the House and the Senate. And since the beginning of the year, they wanted to pass a really big benefit package. The way they were going to do that is through a thing called budget reconciliation, and that is a technical thing that I'll explain later. But basically, what happened is that they couldn't do one big bill, so they had to separate the bills. And so the first bill was infrastructure legislation, and the second bill is the big benefit bill that also has a lot of tax increases. So they've been trying to pass both of these bills since March of this year, and it's going so-so. I'll explain later. So what has happened is that, here's the good stuff, if you think passing legislation is good. The House and Senate passed the infrastructure bill here recently, and President Biden signed the bill into law on Monday. This bill, let me go to the next one. Oh, let me go back. So the infrastructure bill doesn't really have a lot of tax increases in it. It's basically a primary spending bill. And so this has been one of the biggest goals that they've had for months, and they actually could have passed this bill in August, and this president could have signed it into law in August. Instead, they actually held on to it, and I'll explain that later. The second bill is more of a headache, and the reason why is because it has so many provisions in it that you could either hate it or love it, and there's something for everybody there. And so what they've done is they have put this bill into what's called budget reconciliation. And the reason why they had to do that is because this bill only takes a majority to pass both houses. most bills take at least 60 votes to pass the Senate. And so right now, what is going on is that they're trying to push this reconciliation bill through the House currently. And at some point it has to go to the Senate. Let me go forward some. So let's go back to the infrastructure bill. And it's kind of funny because even some of these provisions are already changing. This bill was signed into law. And so one of the tax provisions is cleaning up the super funds. It's basically, if there's a chemical spill at a plant, all the chemical companies pay into a fund, and that fund goes to the EPA to clean up any sort of spill that happened. Oil was exempt from this, but currently the reconciliation bill has a superfund tax for oil. And so at some point, if it were to pass as is, the reconciliation bill would actually have oil companies putting into the same fund in case there's a spill that the EPA has to clean up. The infrastructure bill also has a cryptocurrency reporting requirement. Now, what's funny about this is the definition of who has to actually report this could shrink, because right now what they wanted was brokers to report transactions. But the way it was written, it got a lot more people into that world. Miners, I believe they're called. I'm not up on cryptocurrency, but more people are going to have to report to the bank about transactions in this bill, in the infrastructure bill. However, there's legislation being written in both houses that will actually shrink that number to just brokers. So what Congress is trying to do is define who really should be reporting these requirements. Now, where do those bills go that haven't passed any committee? It's unclear. But Congress understands that there's a problem with this reporting requirement, and they're trying to deal with it ASAP. And for Congress, that could be months. On the employee retention credit, this is kind of a snafu for every small business that is taking this credit. It ended almost a month and a half ago, September 30th. And businesses are still taking it, and it's not available to them. And so right now what's going on is the IRS is saying that they're gonna study this issue and release some sort of guidance. Well, what people or what organizations are lobbying IRS to do is to have no penalties if you took this credit, and allow businesses a lot of time to pay the tax back that they should have paid. And so that's what is being asked of the IRS, and we will see what actually happens. The other things, filing court petitions, I think courts are now open, so I don't know how big of a deal that is. And it also extended deadlines if you're in a fire area to file your tax returns. So that's basically what's in the infrastructure bill. Besides, there's a lot of bond issues in there as well, but I'm not going to go into those right now. And so the reconciliation bill, so let's just put infrastructure away. It's law. Whatever's going to happen to those provisions is what's going to happen. Now, the reconciliation bill is a live bomb. It could blow at any moment. And so Democrats are the only people that are going to support this bill in both chambers. Republicans are not going to do it at all. But this bill is so divisive that it has actually divided the Democratic Party into at least two sections of people who support certain provisions and people who don't support those provisions. And so what has happened is that the Democratic leaders are really trying to walk a really thin line. And the best example of this is the provision for the state and local tax deduction. A lot of reports have come out that have said, if you remove the $10,000 cap, even if you move it up to 80,000, you're going to have more millionaires get bigger tax increases or bigger tax returns bigger tax refunds, I'm sorry, than someone making regular wages. Well, yeah, I mean, they make more money, they pay more tax, therefore they can get a bigger refund, obviously. But that's not how it plays in the press. It sounds like these people are going to get a windfall because they happen to pay a lot of taxes, and this cap would be 80,000, and so they could get more than if the cap was 10,000. That's kind of it. But it doesn't play like that in the press. And the progressive side of the Democratic Party is really against this SALT provision being in the bill because they say it benefits wealthy, and what we really want to do is tax the wealthy. So why are we giving them a tax refund when we really want to increase their taxes? The moderates are trying to hold on to this, and some of those moderates are from high tax, or most of them are from high tax states like New Jersey, where 1/11 of an acre can have a tax, property taxes of $50,000, $60,000. And so, you know, in other areas of the country, that would be a farm. But this is literally 1/11 of an acre, and it's on a house that doesn't, it's just a regular home. So that's why the moderates are trying to say, no, 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 this isn't just for rich people, this is for everybody. But yes, when you increase a tax break on land, you are gonna have a benefit go to wealthier people. It's just kind of a fact, but they don't want to do that. So passage of this bill is, it has to pass, but it's not a sure thing as to what's going to be in it. And so it's dicey. Anyway, I'll go on. So what has happened right now is that both chambers agreed to the reconciliation instructions. That's kind of a big deal because those are the rules that say this bill has to do X to be able to be in a reconciliation bill that can pass the Senate with just 51 votes. And that's a big deal because if you don't follow that path, this bill doesn't pass and it just falls apart. And so what they're doing now, the House, they're actually trying to make this fit within the reconciliations instructions so it can pass the Senate with just a simple majority. And it's currently, we should be getting some sort of information on that, but I don't know if it's going to come out yet. I'll get to that in a second. So here's what's included right now, and these are the tax increases that are included in the reconciliation bill. And I won't read through all of these, but I will show you that the first one, the cap on the state and local tax deduction, is for $80,000. And this would go from 2021 to 2030. Now, currently the cap, the $10,000 state and local tax cap, is supposed to end in 2025. This will continue on. As it continues on, it basically means that this doesn't cost the government any money because they extend the cap out, even though it's increased, but it's extended out beyond 2025. This actually becomes a revenue raiser. It actually makes money for the bill so they can do other things. So the argument that the state and local tax deduction modification is taking money away from paid family leave, they can't use that argument anymore. But it's unclear if this provision is going to stay in the bill. The other thing, I'm looking through this, the other thing that is kind of interesting is that the 15% book tax, the 15% minimum tax on financial statements. This is where FASB would have to come in and deal with the IRS and make laws that the IRS would have to comply with. FASB is the Financial Accounting Standards Board. They do the book side of accounting, and IRS does the tax side of accounting. And the two never meet. Congress tried this a few years ago, and the book tax didn't really work, and they repealed it. So there are major questions onto even if this provision will survive this bill. And then the 5% surcharge on modified adjusted gross income, that also goes for estates and trusts, but the 5%, I believe it's over 200,000, and then an extra 3% over 500,000. And so this is a moneymaker for the bill. Let me go on. So this is what was included in the bill, but got excluded largely because, not because of merit, not because, oh, this is a good tax provision or a bad tax provision. This got excluded because some members of Congress said, I don't like it. And that's why it's out. So when you look at the increase in the top income rate, the capital gains rate, this increase in the state and gift tax exemption, well, that's also out. But that and the step up in basis, they're out currently, but it's unclear if they could be brought back in, because they might need, Congress lawmakers who support this might actually need money to do something. One thing that's of interest is that they didn't touch the pass-through deduction. That was thought that they were going to do that for a while, because basically it helped people making over $400,000 a year, and certain Democrats didn't want to do that.
So that fell off, Jay, but like you're saying, so a lot of these provisions on the last slide as well, including the ones that are in the bill right now, right? And particularly, some things, one thing that was near and dear to the attendees today, right, was that 1099 reporting item, right? For at first it was going to be, banks would have to issue 1099s for all cash ins, cash outs over $600. Then it was 10,000. That's now fallen to the wayside too. But one thing to keep in mind is Jay is doing a great job of going through all these. Is some of this stuff could come back, right? Just because it fell off the table right from, maybe it was in the green book, back in May, it was a proposal, and then maybe it was or wasn't in that first version of this bill. But a lot of this stuff, Jay, and I think you were getting right around to that, a lot of this could come back, even if it did fall out of that first version.
Yeah, it could. And that's basically, it's because of this reconciliation process has very strict rules. And so let me go to the next page. And so this is like something could fall out. It's called a scrub. And basically it has to fit within reconciliation rules. So for example, a reconciliation bill can add to the deficit in the first budget window for 10 years. It can add to the deficit. In the second year, in the second budget window, the second 10 years, it can't add to the deficit. So right now what they're doing is scrubbing the bill. It's called scrubbing. And they're basically saying, okay, will this provision add to the deficit in the second 10 years that it's in law? And if it does, it has to be pulled out. So when they start pulling everything out, you have to fill it in with something else. And if you don't fill it in with something else, you have to make it temporary. So if something increases the deficit in the second 10 years of a budget window, you can only make it last for 10 years. And that's what happened to the entire individual tax code in the 2017 tax reform bill. It only went for 10, it's only now alive for 10 more years. And the idea is that, oh, we'll extend it in 2025, so it goes further, but we just couldn't because of reconciliation. So after the bill passes under the protections of reconciliation, you can extend it forever because it's done. And so that is something that is a lot of provisions in this bill are kind of based on not living forever, because Congress will extend them eventually before they die. So let me get to what's going on right now, because it's basically the House is wanting to vote on this bill as soon as possible. And what that means is that they have to have something from the Congressional Budget Office, which shows that what this bill is going to cost. And what some moderates have said is that if this bill adds to the deficit within the first 10 years, I won't vote for it. And they have 4 House votes. Since no Republicans are going to support this bill, if 4 Democrats oppose it as well, this bill fails. Currently, and this is the CBO is supposed to release the actual cost of this bill, like could be at any moment, to be honest. But currently, the current math from some of the very smart people in DC is that the way the bill is expected to be written, it will add to the deficit in the first 10 years for between 270 billion and 350 billion over the first 10 years. So it will add to the deficit. So there are 6 House Democrats that have said, if it adds to the deficit, we're not going to support it. Now, will they really do that? Who knows? But Congressman Pascrell from New Jersey told reporters earlier today that if it's negative, quote, all bets are off, which means he's a no for supporting the bill. Well, it only takes 3 more of him and this bill dies. And so it's really going to be kind of interesting to see what actually happens with this. And now Speaker Pelosi today said, we're going to vote on, she said at 10:45 this morning, we're going to vote on this bill this afternoon. It's like, wow, really? You're going to get the CBO score and all that stuff, and you're going to scrub it with the Senate to make sure it's all good. And so right before I came on this event, she said, well, it might go until we might vote on it tonight because we have to do the scrub and get the CBO score. And then I just saw a quick hit on my phone. It says, well, it might go tomorrow. We might vote on it tomorrow. And so basically they're going to vote on, the House is going to vote on this bill before they leave for Thanksgiving. And so it is between, seriously, right now and midnight Thanksgiving morning is when they could vote on this bill. And one of the issues that they're having, and it's really coming down to, if this bill becomes negative, and if it includes a SALT provision that even pays for itself, some people just don't like it. And so the problem that the Democrat leaders have that want to pass this bill is this bill has been in existence for so long, people can argue about it for forever, and they can think about it for too long. Imagine that, thinking about a bill before you vote on it. But many times they don't even read the legislation. And so what's going on is that people have dug into the point to where they can't get out. They've said the same thing, like, I'm for this for 6 months. And suddenly, if that provision is not in the bill, how do you then support the bill? And it's paid family leave, it's immigration, it's not just taxes, it's a plethora of other issues. And so the thought is that between now and Thanksgiving morning, this bill will pass the House. And at that point, it goes to the Senate. And when it goes to the Senate, a lot of changes are going to be made. And one of the biggest ones is SALT. And so the SALT cap that is currently in place is $10,000 cap for everybody. What the Senate might do is remove the cap, make it unlimited. The SALT cap can be unlimited again for incomes under 400,000 or incomes under 550,000. It's unclear if that's individual, if that's joint, or what. But like they actually are saying, like we just want to make this unlimited for people making under 400, but keep the cap, the $10,000 cap, forever for anyone making over that. And this is AGI. It's not income, it's AGI. And so that would be like, that $10,000 cap would be forever, which means it's a huge money raiser. And so because after 2025, it goes unlimited. So that means that cap is actually saving the government money from giving tax returns to other people. So when they deal with all that in the Senate, they also have to do something that's called a Voterama. And a Voterama is where any senator can bring up an amendment for this bill And it doesn't have to be even in the jurisdiction of the bill, because the Senate committees are not going to work on this bill and pass something out of committee that goes to the floor. And I'll explain why in a second. So that means that because it didn't go through committee, you could do an amendment of, hey, I think that, you know, sheep should be able to drive cars. And that would be an amendment on the bill. Here we go. And then they have to vote on it. Then they have to debate it. And when they say 10-minute debate in the Senate, it basically means an hour and a half. And so you're talking a very long process of hundreds of amendments, and it's going to take a while for the Senate to even work through that. Now, the reason why they basically are not expected to go through committee is because it's called the power sharing agreement. And the Senate is split 50 Democrats, 50 Republicans. And the person that breaks a tie is the Vice President Harris. And so that's essentially 51 Democrats and 50 Republicans. That power sharing agreement that it's okay for the Vice President to break the tie doesn't translate to the committees. The committees are also evenly split 50-50. So any bill that comes out that would not really actually pass, it would be 50 against 54, or 50% against 50% for. So what they had to do is basically say, okay, if a bill's going to the floor, it has to like have a time for people to like vet about it and talk about it, and then we'll vote on it, and then we'll see if we can actually bring it to the floor. And so, of course, they do that. And the Democrats who run the Senate say, of course, we'll do this bill right now. And so they do that. But a reconciliation bill has to go from one committee to another, and that's the Budget Committee. And the Budget Committee, that power sharing agreement does not exist. So basically, because of the reconciliation protections, this bill can only come to the Senate floor where they're going to have dozens of amendments, and it's going to take a while. So when will this all be over? All right. Okay. So let's just say that the House passed it. It's now Thanksgiving. Everyone goes home. All the lawmakers go home. They return in a week from Monday, which is, I think, December something. So the Senate now works on it. Now they have to go through all their stuff, and it's going to take a while. And so a lot of people are saying that this bill will pass in possibly Christmas. Well, a funny thing happened. I was on a phone call with Senator Tester earlier this week, and he said, you know what? I'm optimistic that we're going to pass this bill this year. And one of the thoughts that occurred to me is like, well, everyone thought it was going to pass this year. Why are you optimistic? Why do you have to be optimistic for this bill to pass this year? And normally when a lawmaker says that they're optimistic about something, it means the sky's about to fall. That, you know, this isn't going to happen, but I'm thinking good thoughts for it. So therefore I'm still a good guy. But no one thought this is going to go into 2022. So when he said that, a lot of eyebrows were raised. And so I was at a meeting yesterday with staff with tax staff that actually wrote this bill. And I asked them, I said, if this goes into 2022, what happens to all the effective dates for the bill? And there is room for the tax provisions, the tax increases to be worked on before, you know, they're not automatically due right away. But a lot of the tax breaks that people get come active on January 1. Now, granted, they don't do their tax return for a while, so you have time for that too. But as this bill goes into 2022 and it goes into, say, February, you get into election season, and a lot of people aren't going to want to deal with this bill at some point, because one thing that's happened is that some of the moderate Democrats are actually getting good polling if they oppose the bill. So that could help them actually, that could be their campaign reelection, is that I was against the reconciliation bill, vote for me, because currently the Democrats are supposed to lose the House in a very big way next year. And some of the moderate House Democrats are seriously questioning, why am I going to support this bill that's going to be the death knell of me a year from now? I'd like to keep my job. I like being a congressman. And so there's a lot to shake out here, but basically the smart money would be that this is going to end somewhere between Christmas and New Year. And it literally might be New Year's Day.
So Jay, as we head into the year end, right, if we're a bank doing tax planning, trying to figure out, right, are we going to have, what are the tax rates that we should expect for 2022? What should we be doing yet in 2021? It kind of seems like it could be a crapshoot, whether you're an individual, an S corporation, or, you know, C corporation tax hikes. I would assume, Jay, you can't say they're completely off the table yet, correct?
Yes, I wouldn't say anything's off the table. And I remember, I don't know if you remember the fiscal cliff of 2012.
Yes.
That was New Year's Eve.
Yep.
That bill was happening live on New Year's Eve. And it's so funny because I actually was calling, I worked for another lobby shop at that point, and I was calling the Ways and Means Committee, and the staffer picked up the phone and I said, "Oh, you're there." And it was like 11:30 at night on New Year's Eve. He goes, I go, "Oh, well, you're there." And he goes, "Well, you called. Did you expect me not to be here?" And it's like, "Oh, I kind of did." He goes, "Well, what do you want? I want to get out of here." And like, "Well, we're not going anywhere." And like, he finally emailed me at 2 a.m. He said, "I finally left the office at 2 a.m." So yes, this can go until New Year's Eve. This really can.
And if we remember the 2017 tax reform, right, where, you know, tax rates were kind of going the other direction and we were actively planning, I mean, that didn't get passed and it wasn't signed into law, Jay. I think it was December 22nd, right, before that got signed. So
it was close to that.
Yeah.
There was also a question on if Trump was going to sign it, and K Street was freaking out about that because he hadn't signed it yet, and it was there. And all of a sudden, in the middle of the day, there became a panic in Washington of like, is he going to sign it? And he finally did. But there were definitely questions about, you know, how do you do this? But no, you really can't assume. I mean, the mere fact that rate increases are off the table has really infuriated a lot of Democrats who want to tax the rich. That's what they want to do. And so if something falls out because of the scrub or a thing called the bird bath, which is another thing, the simple way to put it is like, that's another way to not follow reconciliation rules. Something has to replace it or something becomes temporary, and that's hard to do. But the thing to look at is that the Democrats are not happy about this bill. No one is in love with this bill. And it only takes 4 of them in the House and none of them in the Senate. If one of them says no in the Senate, this bill dies. You're looking at 5 people could say no to this bill in total, and it goes away. And so I think it is, just keep an eye out for, you know, what could change in this bill as it goes through. And, you know, we're looking at maybe 6 weeks of really hardcore legislative work, because whatever the House has done, the Senate's definitely going to change. And the Senate's going to change it through amendment on the floor. And so at least we'll see it that way. But this bill is in no way, shape, or form a done deal. So I'll leave you with that. Oh, I'm sorry. I have one more thing. Besides doing this bill that they're going to have to do with forever, they also have to fund the federal government beyond December 3rd, increase the debt ceiling, now we know, by December 15th, fund the highway funding. Well, that's actually done already. Never mind about that one. But they have to fund national flood insurance and also keep up state and local coronavirus relief stuff after December 31st. So their plate is extremely full. And they also have to fit in on the Senate side a thing called Voterama, which can take days. So this is going to be an action-packed last part till the end of the year, and it might go into the next year. So with that, sir, I give you the
All right.
one.
Thank you much, Jay. Appreciate that update. So Jay kind of brought us up to speed on where Washington is, or maybe where it isn't, right? With with this reconciliation bill and these highly anticipated tax policy changes that we've been waiting for. You know, the Treasury's Green Book came out, seems like a long time ago, back on May 31st. And that contained a lot of kind of the budgetary tax proposals, right, from the Biden administration. So back then we started talking to a lot of you, you know, a lot of our bank clients about, and you were reading a lot about a 28% C corporation tax rates. You know, a lot of other, you know, different, you know, a 39.6% individual rate was included in there. Talked about some pretty crazy estate tax reform, right? Doing away with basis step-ups, you know, taxing estates on but the difference between fair market value and basis of assets as a capital gain, like a taxable transfer upon death. So there are some crazy things kind of in that Green Book. Some of them made it into that first bill. Some were a little different, you know, than originally proposed in that Green Book, and some didn't make it at all. Some made it into the second, you know, version that Jay just went through here. So there's been a lot of information, and, you know, frankly, it gets confusing. There's a lot of stuff swirling around because you heard a lot of different things all summer about proposed changes, and now the proposed changes are different, you know, than what they were there. So Jay and our DC folks are doing a great job of keeping us up to date and abreast of where Congress is now, helping us communicate with our clients, with you and banks about what they should be keeping in mind as we approach year end here. So with all that said, you know, the question on the first slide here is, well, what will an effective tax rate increase be applied to my bank or to our shareholders for 2022? That remains to be seen, right? We will, you know, like I said, we'll have to keep an eye on that. You're going to have to maybe plan accordingly for 2021 year and maybe have a dual plan, right? For rates as they are now, which as legislation sits, looks like they may not change for a C corporation. There is some changes, right, that you need to consider right now that are in the legislation if you're an S corporation. As Jay said, the 3.8% net investment income tax, you know, that normally only applied to passive shareholders of an S corporation bank, right? Passive is defined for this purpose as those shareholders with 100 hours or less of activity, you know, being involved with the S corporation, with the bank. Now, you know, this proposal is that the 3.8% would be applicable to all shareholders, you know, regardless you're active or passive, if you work at the bank or not. There is an income threshold. I think it would apply to those shareholders with 500 grand or more of income, I believe. But again, that could cause an effective rate increase for your S corporation. If you have any shareholders where it would be hitting them more, if you haven't been distributing, right? If your tax distribution plan didn't include that 3.8% net investment income tax, well, there goes more bank capital, right? If this passes, because your shareholders will want that distributed to them, more than likely, not in every case, but in a lot of cases, in order to help them pay for that tax on their S Corp K1 income. And then, as Jay mentioned, if you're an S Corp bank, you have to remember the proposed surcharges, if you will, or surtax, right? The 5% surtax or surcharge on adjusted gross income in excess of $10 million. And then they'd lop on 3% more, so a really total of 8% then once you're over $25 million. So if you're a profitable S Corp and, you know, if you're closely held, not many shareholders, you know, there could be an impact there potentially. But if you're an S Corp that's widely held, your income goes in a lot of different directions, maybe that's not as big, you know, of an issue. So it's kind of when we ask that question, will an effective tax rate increase, you know, impact your bank or its shareholders for 2022? we have to give that age-old answer. It depends, right? What your situation is, and we don't even know really where that legislation is going to end up. As Jay said several times, nothing that we talked about or nothing that's been proposed is completely off the table yet. You know, we can't say with certainty C Corp rates will not rise, or it's impossible for them to rise. So what should we do for tax planning for 2021 year end? Are we going to have higher rates in 22, or are they going to be roughly the same? So let's consider some of the implications, right? If we think tax rates are going to increase in the next year, we kind of, if you want to call it reverse tax planning, we consider accelerating income, right? Pulling income from 2022 into 21, if possible, and deferring deductions, not taking everything we could, but whatever we're able to push deductions out into 2022 and future years when we think tax rates are going to be a little bit higher. What that does, you know, if it's enacted, you know, as Jay said, we don't know, even if it gets passed, it may not be signed by the president by the end of the year. But if it's enacted and in effect on December 31st, if there are higher, you know, let's say there's higher corporate income tax rates, you know, like could come back, we don't know. But if that be the case, our deferred tax assets, right? If we have a deferred tax asset on our balance sheets, well, that would be increased. That, I guess, temporarily would be a good thing, right? We get to take a one-time bump on our deferred tax asset if we're a C corporation, should those rates be enacted before the end of the year. So that's why you defer deductions, right, into future periods. Our deferred tax asset would take a bigger jump if we're a C corp. So, you know, things you have to consider though, right, before you go full on out into a plan of you know, reverse tax planning and accelerating income and deferring deductions. You know, what is the cost of the funds associated of paying, you know, accelerated tax liabilities, right? What's the opportunity cost? You know, right now, I guess cost of funds on a typical, I should say, a typical bank balance sheet is relatively low. You know, if we accelerate tax a little and pay that up front here, you know, that's liquidity we're taking off of our bank balance sheet and paying in, you know, to the treasury and to our states. So what is the opportunity cost to the bank of, you know, accelerating that liquidity leaving our balance sheet a little earlier? You know, again, for a C corp, like I talked about, you know, we're beefing up. We'd be beefing up a deferred tax asset just in case that rate does go up here, kind of at the 11th hour. You know, if you do build up a really big deferred tax asset, you know, it could have an impact on risk weightings. Just kind of be aware of that, and remember that old Basel III rule that, you know, if you would reverse out your entire amount of deferred tax deductions, right, net of any deferred income, you know, if you net out or reverse out the deferred tax items all at once, and if all that reversal would cause a net operating loss, which likely a lot of cases it would. If you don't have enough prior year taxes this year, it's a 2-year carryback. You know, if you couldn't carry that whole loss back, if you reverse it all, any reversal dependent on a carry forward, right, on future income, if it's dependent on using future income, the reversal of a deferred tax item, that's a 250% risk weighting. So just something to be aware of. There's also, and I don't have it on the slide, but you know, it can only be 10%, you know, of total capital. There's other Basel III limitations. Just again, the point is, be aware of Basel III limitations if you're looking to beef up a deferred tax asset. And again, but you didn't need to consider in that last bullet point really kind of is in congruence with the first bullet point. You know, if you're going to pursue these strategies, you know, to accelerate income and defer deductions, you're probably going to have to you not have to make the final decision on that strategy until you actually file the 21 tax return, but you're probably going to have to beef up that fourth quarter estimate, right? If you're calculating estimates as you go, if you're a corporation, you know, if you're a large company, large corp doesn't have the safe harbor you know, provisions that an individual shareholder would. associated with an S corp. So you'd have to pay that in ahead of time. So there goes that opportunity cost that I was talking about earlier about taking this approach. So again, reverse planning. What are specifically, some items you could consider if you felt, right, if things turn in Washington and we think tax rates are going to increase like we've been hearing all year, right, up until the last 2 or 3 weeks here. If they move back that direction, and if you're in a situation where it would impact you, you could consider some bigger moves, right? Moving to less favorable accounting methods. If you're cash basis now and you're deferring income as a cash-based taxpayer, you can certainly switch back, right, to an accrual and recapture that deferral. Problem is, that's usually when you're recapturing income with a method change, that's over 4 years, right? So you could only get 1/4 of that moved out, and then that's spread. The other 3 years are spread out over, into those periods with potentially a higher tax rate. So you're not picking up a whole lot, and then you're locked into that, if you want to call it an unfavorable accounting method, for the next 5 years before you can switch it back. So that's a move you could consider, but again, consider what the opportunity cost is, before you would move into that. Some other things that you can decide when you're doing the tax return. So again, if it's like Jay said, a December 31st passage, some decisions you can make with the tax return. You can elect out of 100% bonus depreciation, or, when it comes to repairs for your fixed assets, do not make the de minimis safe harbor election and, depreciate smaller items instead of electing to expense them as repairs. But again, consider the consequences, right? We are pushing, the remainder of the depreciation. If we don't take 100% bonus or Section 179 and take the whole cost recovery in 2021, yes, we are pushing, the remainder basis of those assets out for depreciation in future periods with potentially higher depreciation. But consider again the time value of money. Assets take a few years. It's not just a 1 year, this year or next year thing. That's going to take 5 years or 7 years or maybe 15 years, depending on the life of the asset. To recover that cost then for tax. Is it worth deferring it, for that long? So that's something you'll have to consider. Of course, S versus C corporation, as I mentioned earlier, the 3.8% surtax applicable to active shareholders, the 5% and then the 3% surtax is proposed right now on higher income, $10 million and $25 million gross income on those taxpayers. That could factor in, if C corp rates do stay at 21%, but then your S corp, the individual rates of your shareholders, if those jump as a result of this legislation, you may want to take a step back and look at, is an S or a C our optimal tax structure? And again, I always stress, it's not just tax rates that play into that decision. Really, it's your philosophical approach. What is your strategy? I should say your strategic approach. Do you pull out, your profits? Is the single layer of tax, if you're not paying a lot of dividends, and you're not, your number one goal is capital retention, and you don't have a sale on the horizon, so that basis buildup you get with S corps, is that really a benefit or not? What's your ownership strategy? Are you going to pass the stock through estates to the next generation, where a step, the basis increases of an S corp, maybe that's not a benefit, or maybe it's way down the road. So again, capital retention, ownership, growth strategies, that all plays into the S versus C. It's not all tax rates, although it is a important component. But this is always a good time. 4 years ago, a lot of banks had this conversation, or a lot of taxpayers did, if they should retain an S election or make an S election. S versus C was a hot topic 4 years ago, and it probably will be again now. Tax rate changes are usually the impetus of that conversation. But again, it's a conversation and an assessment, that a shareholder group and a management team need to make periodically to determine that, hey, with changes in the environment, changes in tax rates, maybe changes in our strategy, is an S or a C election the right way for us to go. And some other things we can consider, for again, if we're looking to push deductions into next year, we'd prefer if we don't take the deduction in 2021 and we're deferring it with the thought of a higher tax rate getting a better benefit. We prefer a 1-year deferral, right? If we don't get it in 21, it'd be best if we just get it all in 2022. Some things that you can do is like your bonus plan. If your cash basis, obviously, if you don't pay the bonus in 2021, if you pay it in January, you get a better deduction. Of course, on the other end of that are the employees getting the bonus, what's happening to their tax rates right now, kind of staying stagnant, but so is the C Corp rate for now. So again, you could consider timing of the bonuses, to maybe pay it later, to push that deduction into the next year, or maybe not fix the liability, make it so it's a fluid and it's not a fixed bonus pool. That would make it not deductible for an accrual basis taxpayer, even if it's paid within 2.5 months after the year end. So bad debt deductions, there is some flexibility there. If you're on the specific charge-off method, or even if you're a smaller C Corp on the experience method, you're not required to deduct a partially worthless loan in the year that you book the charge-off. You can deduct it to the extent that a partially worthless loan is charged off on the books, but you can elect to wait until the year that loan becomes wholly worthless. So you don't have to deduct partial charge-offs in the year of charge-off. You can wait for that bad debt deduction. You'll have to track that loan separately and take that tax deduction in a future year when that loan becomes wholly worthless. So that's one other item you could consider if you're looking to defer deduction. Capitalizing loan costs, again, proceed with caution there. You can make an election. Some banks, I'm a tax guy, I still call it FAS 91, right? If you're capitalizing fee income and cost of writing loans and amortizing that off into your earnings over the life of the loan. Typically you for tax purposes, there was a lot of contention in this area. There was a key case, PNC Bancorp, around about 20 years ago here, that said, yeah, for tax, we deduct our cost, even if we're deferring our fee income over the life of the loans. For tax, we deduct the costs right, immediately as we pay them, as we incur them. You can elect to capitalize those loan costs for tax and deduct them over the life of the loans. And that's on a cutoff method. So you could elect it for, say, 2021 and defer those loan costs on loans booked in 2021 over the life of those loans in future periods. And it's a year-by-year election. You'd have to track those loans separately, of course, and amortize those loan costs into tax as a deduction in future years. But again, how many years are you deferring that deduction for? Is it too many years in the future? That really diminishes the benefit, right, of that rate change. Again, I talked about tax depreciation, and there's a myriad of things that you can kind of consider, right, to accelerate income or defer deductions. But again, we don't know, where we're going to be necessarily for tax rates, but it's good to have those discussions and kind of have a game plan down. Like Jay said, should tax rates for corporations come back onto the table, to have a plan in place. So it's important to have those conversations now. Moving on out of income taxes briefly to payroll taxes here. The employee retention credit has been a hot topic of conversation not just in the banking industry, but nationwide here the last year. This came out of the CARES Act back early in 2020. And the slide is not updated. This is no longer a proposal. As Jay said, the infrastructure bill did pass and was signed into law. The fourth quarter of the employee retention credit for 2021 went by the wayside. It's only available for the first 3 quarters of 2021. And what is this payroll tax credit? Well, it's a refundable payroll tax credit that you claim it on the payroll tax returns, the Form 941. The 2020 credit was, the max credit was 50% on the first 10 grand of wages per employee for the whole year. So 5 grand per year per employee if you qualified. For the 2021 credit, I think on the 2020 credit, I said that should say, I see it now, if it's greater than 100 employees, it should say. So if you're taking notes, that should say 100 employees, not 500. And then on the 2021 credit, they kind of supercharged it for 2021. It's 70% of the first 10 grand wages per employee. So a 7 grand credit per employee, but it's per quarter. It's not for the year, it's per quarter. It's important to note that if you do qualify for this credit, again, you have to forego the S Corp or C Corp deduction, whatever you are. You cannot deduct salary expense in the amount of that credit. The IRS has said, hey, effectively what we're doing, we're giving you this credit. You retained your employees if you qualified for this credit. We're kind of like, we're reimbursing you for keeping people on staff if you qualify for this credit. So we're not letting you take a deduction, for your full salary expense. So that's important to note. It's not a dollar for dollar credit. You got to give up some tax deduction as well if you qualify. How do you qualify? Eligibility is determined on a quarterly basis. We compare basically 2019, or I'll get to that on the next slide, I guess. There's 2 ways, I should say. I'll get to the gross receipts test on the next slide. Kind of the first way to consider qualification is if your business was directly impacted by a government order, that more than nominally impacted your business, you would qualify for this if you retained your employees. So restaurants come to mind, bars and restaurants, businesses that were not deemed essential. Now, banks were deemed essential in most cases. Again, it's facts and circumstances. It's state order by state order. So you need to approach it that way. But in most jurisdictions, the government did not directly order a bank to close its lobbies or cease operations. So it kind of makes it hard for essential businesses to qualify under that purview. But if we go to the gross receipts test, in 2020 and 2021, you go on a quarter by quarter basis and compare the gross receipts of the quarter in 2020 or in 2021 to the corresponding quarter in 2019. So if in 2020, first, second, third quarter, you go quarter by quarter, and if you decrease gross receipts by at least 50% during 2020, you would qualify. But again, in 2020, you just got the 1 credit for the whole year. In 2021, you only have to decrease your credit or decrease your gross receipts by 20%. And if you meet that gross receipts threshold, decrease threshold, you would qualify potentially for the credit. And again, in 2021, there's an extra provision that if you can elect to use the gross receipts for the preceding quarter in order to qualify. So let's say you qualified in the first quarter, you had a 22% decrease in gross receipts, you automatically qualify then for the second quarter because you can just elect to use the first quarter's gross receipts test to qualify. So again, make sure you're talking with your tax advisors. Gross receipts, there are varying interpretations out there. How do you define gross receipts for income tax purposes? How does the IRS define it? So make sure you're just talking with your advisors and seeing, would your bank possibly qualify, for this payroll tax credit? Moving on briefly, a lot of states have elected, 20 states in number now, and that some have proposed it. Jay talked about, right now, there's a $10,000 per person limit on the deduction of state and local income taxes. So state taxes that an individual pays are lumped in with real estate taxes, and they're limited to 10 grand. Well, a lot of S Corp shareholders, they hit that 10 grand on other income other than their K1s, right? So on their wages or other income plus their real estate taxes. So they're paying state income taxes on their K1 income and not getting a federal tax deduction. So this is called a state tax workaround or a SALT workaround that 20 states have passed. It makes available an election for an S corporation to pay tax at the S corp level. And the IRS has signed off, as I noted there in Revenue Notice 2020-75, that this is an entity level, it's a corporate level tax. You can deduct that on the S corporation bank's 1120S on the federal tax return. So in essence, the S corp pays tax to the state on behalf of the shareholders, and then the S corp shrinks its federal taxable income for that. It's not, you'd think, what a deal, why wouldn't we do this, right? It depends on the circumstance and your shareholder base. I had a discussion with a client where management team thought, good idea, I think we're going to do this, but then the 65% shareholders said, no, I have losses from a bunch of other sources. I don't pay state income taxes. So it didn't make sense for the S corp to pay in a bunch of state income taxes when most of the income, wouldn't be producing a state tax liability. So it all depends on the shareholder mix and how they are impacted. It's not a slam dunk. Again, it's a facts and circumstances situation that you'd have to consider. So again, real quick, meals and entertainment. I'm going to go real quick here. Thing to be aware of for 2021 and 2022. Meals that you purchase from a restaurant, right, are going to be 100% deductible. So make sure your accounting systems are kind of set up, to accrue for that correctly if you're a C Corp, and make sure you're giving your accountants the right information. Restaurant is, as I have it on the slide, defined as a business where food and beverages are available to be consumed on the premises, right? They're ready to eat. But takeout, it doesn't have to be consumed there. It can be, takeout from a restaurant would qualify for this. So just something to be aware of. It was meant to kind of jumpstart the restaurant industry here for the next couple of years. So we have some definitions here of what a restaurant is, and does not include employer-provided eating facilities if you have a cafeteria on campus. Real brief reminder, debt issuance. Cost, subordinated debt was a really hot commodity in the banking industry here this last year. Just kind of remember, as you go into year end here doing your tax planning, that debt issuance costs, facilitative costs like legal, accounting, placement costs, right? If you paid an investment banker, that the debt issuance costs are generally not currently deductible. This isn't an elective thing like I was talking about before. You kind of don't have flexibility with this. You have to capitalize those for tax purposes and spread them out and deduct those costs over the term of that debt. So just be aware of that if you have that. And the LIBOR transition, not a huge deal in many cases, but if your bank had a lot of loan instruments based on LIBOR rates, you're required. The regulators are pushing banks to move away from LIBOR to something else, to SOFR or to prime rates is the most common thing I'm seeing. The IRS has issued a regulation in RevProc 2020-44 saying that if we transition away, if we get that done before the end of 2022, we don't have to worry about the debt modification rules where you could have potentially a gain or loss when you're modifying the rate of a debt instrument. We get to not, if it's for this LIBOR transition, it will not impact us. The IRS gave us some time to comply with the regulatory requirements and move away from that. So sorry, I went a minute over here, I guess, but we're at wrap up here. Do we have any questions to go through?
Paul, I don't see any questions right now, so I think we're probably at time.
We both talked as fast as we could. So.
A lot of stuff going on, right?
Yeah. The sun is also setting here in DC, so I'm slowly fading to black.
All right. Well, again, I want to thank all of you for joining us today. I want to thank our speakers, Doug, Duncan, and Paul and Jay. And to the audience of bankers and industry professionals, I want to thank you for your time and attention. Remember that some of our presentations will be available via playback for those in your bank that did not get a chance to attend. If you go out to idebailly.com/bank seminar 2021, you'll be able to see those. And from these today, hopefully within the next few weeks, we'll get those up as well. I did want to recognize someone today. This seminar originally was meant to be in person in Fargo. We have Tim LeClaire, who is a financial institution partner in our Fargo office that will be retiring in April. And Tim, you'll be missed greatly, not only by me, but all of us within the firm. I just want to thank you for all that you've done for our firm, for our FI group, and for all of our clients. You're just awesome, and you will be missed. I also want to thank Amy DeGeorge and Cheryl Knudsen for all of their hours, all the things that you've done for us to get this through this. On behalf of Eide Bailly and all of our financial institution partners and staff, thank you all for what you do for the communities that we live in, and thank you for your business.